Over the past decade, the stock market has arguably been the premier destination to channel our savings. It's been a golden era where the earnings per share of the leading global index, the S&P 500, have doubled. Consequently, the index itself hasn't just doubled, but tripled, showering considerable wealth upon savvy investors who dip their toes into this market. A significant factor contributing to this stock market boom has been the accommodative stance of central banks worldwide. The cost of money has been at historic lows, readily accessible to all companies. This enabled businesses to access external capital, fueling their growth trajectories and consequently generating ever-increasing returns for both them and their investors. However, this golden age of markets has drawn to a close. The onset of the pandemic necessitated central banks to slash interest rates to the minimum and implement unconventional monetary policies, injecting copious amounts of cash into the economy. While these measures provided much-needed short-term relief, they sowed the seeds for a more significant issue: runaway inflation, reaching levels unseen in the past 40 years. This surge in inflation is rapidly impoverishing the global population, prompting central banks to act aggressively, withdrawing these stimuli and once again raising interest rates to cool down an overheating economy. These developments have triggered significant declines across various assets. Major indices have plummeted by over 25% year to date, and even the real estate sector, though resilient initially, is now feeling the pinch from rising costs of money and credit restrictions on citizens. Fear has gripped all investments, with investors unable to withstand the uncertainty, leading to massive waves of selling. However, I must tell you that this asset sell-off presents the greatest opportunity in history for savvy investors to capitalize on the panic of others. In this video, we'll explore why now is the best time in the last 50 years to start investing and how we can leverage the market's turmoil with two solid investment strategies. So, smash that like button and let's dive in. Before delving into the two strategies to capitalize on this unique investment opportunity, let me highlight a crucial aspect you must grasp before making any investment: the psychological component. Understanding a company's value and obtaining its intrinsic value is relatively straightforward. My advanced course students achieve this in under 30 minutes. However, as I always emphasize, making an investment decision because a company seems attractive and priced well is merely half the journey to investment success. Throughout the investment journey, we'll face the noise and volatility of the market, testing our conviction in that company. Most people invest in stocks with a fundamentally flawed approach. They buy when the company is rising and sell when it's falling. These actions mainly occur during market euphoria or fear, turning most investors into sheep following the herd. Yet, the world's greatest investors, Warren Buffett, Charlie Munger, Peter Lynch, and Seth Klarman, don't adhere to market norms. They define themselves as contrarian investors, buying when everyone else is selling and selling when everyone else is buying. This approach allows them to generate extraordinary returns. In Buffett's own words, "Be fearful when others are greedy, and greedy when others are fearful." Now, let's explore the two effective strategies we can employ amidst this market turmoil. The first strategy is dollar cost averaging, DCA. This investment strategy involves regularly buying an asset or a group of assets over time, regardless of the price. To simplify, let's focus on DCA for the S&P 500, the most accessible, least costly, and most profitable way to invest in stocks since 1957. The S&P 500 has delivered an annualized return of 11.8% over the years. Picture this. You kickstart your investment journey today with $2,000 in an S&P 500 ETF. Embracing the dollar cost averaging DCA strategy, you consistently contribute $300 monthly, unfazed by the S&P 500's market gyrations over the span of 40 years. With an anticipated annualized return mirroring historical averages, the result, a staggering $2,836, $353.73 in your portfolio. Astonishing, isn't it? This sum could seamlessly secure your retirement, all without delving into individual company analysis, fretting over market volatility, or enduring economic downturns. The second strategy is value investing, primarily used by Warren Buffett. For this strategy, we need to possess investment knowledge, analyze companies, and determine their intrinsic value. As Buffett famously said, "Price is what you pay, value is what you get." In the current crisis, due to rising interest rates, we must be highly selective with our company choices. To thrive amidst this crisis, companies must possess two key qualities: clear competitive advantages. Companies should be able to pass on increased costs due to inflation to their customers without affecting demand significantly. This is achievable for businesses providing essential goods or services or operating in resilient sectors like luxury, where demand remains robust during recessions. Minimal debt dependency. Investing in companies with little to no debt or the need for external capital for growth is crucial. These companies can continue growing and expanding using their cash flows, unaffected by rising interest rates. This ensures that investors continue witnessing increasing earnings per share. Combining both strategies, utilizing DCA while being selective with value investments, offers a robust approach to navigating through market turmoil and securing long-term returns. In conclusion, the current situation presents the best investment opportunity in the last 50 years. In a market overshadowed by fear and uncertainty, astute investors possess a unique opportunity. By strategically harnessing dollar-cost averaging and value investing techniques, they can cultivate wealth steadily, impervious to market oscillations. Dollar-cost averaging ensures consistent investment regardless of market conditions, while value investing empowers investors to identify undervalued assets primed for growth. Together, these strategies offer a resilient path to financial prosperity, allowing investors to capitalize on market downturns and capitalize on opportunities. Amidst the tumultuous market environment, those who adeptly navigate these strategies stand poised to thrive, turning uncertainty into profitability. I hope this video has provided value to you. If you have any doubts about these strategies or the current market situation, feel free to leave a comment, and I'll get back to you promptly. Wishing you all the best in your investment journey. Remember to subscribe to the channel and hit the notification bell so you don't miss any of our future videos.